Silver hit $86 today, and everybody thinks that's a recovery. It's not. It's a trap. Because the people bidding this price up, they're not buyers. They're shorts, closing their positions, running for the exits. And once they're done running, there's nobody left. That's what no new buyers looks like on a chart. And that is exactly what we're seeing right now. Stay with me. Because what's about to happen in the silver market in March 2026 has never happened before in modern financial history. Let's start with the single most important number in this market right now. And it's not the price. It's open interest. Here's what open interest tells you. Every time a new buyer enters the market with conviction, fresh money, new position, open interest goes uppy. That's how real bull markets are built. But right now, open interest is in free fall. Silver ran from roughly $74 on February 5th, all the way back up to $86 today. A $12 move. That should mean a wave of new participants flooding in. Instead, open interest collapsed. That inverse relationship, prices rising while open interest falls, is one of the clearest signals in technical analysis. It means one thing only. Shorts are covering. The bears are buying back their losing bets, and once the last short has closed, the bid evaporates. This is what's propping up $86 silver. Not conviction, not new money, just trapped shorts doing the math and choosing survival. When that mechanical bid runs out, and it will, there's nothing underneath it. Now, let's talk about the people who are supposed to be buying silver. The hedge funds, the CTAs, the managed money crowd. In July of 2025, managed money held nearly 45,000 net long contracts on COMEX silver. These are the professional momentum players, the people who drove silver's 2025 rally. Fast forward to February 10th, 2026. That net long position collapsed by nearly 90%, from 44,987 contracts to 4,569. Almost nothing. These aren't retail investors panicking. These are the most sophisticated market participants in the world. Hedge funds, algorithmic traders, they are gone. And why did they leave? Because of the Warsh shock. On February 5th, the Trump administration nominated Kevin Warsh as the next Federal Reserve Chair. Warsh is a monetary hawk. The moment that nomination hit the wires, the dollar surged, Treasury yields spiked, and silver fell off a cliff. In a single session, silver dropped from $90 to $73. That was one of the largest single-day drops in silver's history, bigger than almost anything we saw in 2-8, comparable to the carnage of Silver Thursday in 1980. The professional money didn't just reduce exposure, they fled. And they have not come back. That's what no new buyers means on the COT report. The institutional conviction that drove silver to $121 has been replaced by caution. And without those buyers returning, this $86 level has no foundation. But the war shock wasn't the only bomb that went off that week. 1 week earlier, on January 28th, the CME Group quietly raised margin requirements on silver futures from 9% to 11%. That might sound like a footnote. It was not. When you're trading futures with leverage, a margin hike is a forced liquidation trigger. If your position was sized for 9% requirements and the exchange suddenly demands 11%, you either come up with the cash immediately, or your position gets automatically liquidated. For traders who had leveraged up during silver's run to $121, this was devastating. The margin hike created a cascade. Prices fall slightly. That triggers margin calls. Traders can't meet them. Positions get force sold. Prices fall harder. More margin calls, more liquidations. This is almost identical to what the COMEX board did to the Hunt brothers in 1980 with Silver Rule 7, restricting trading to liquidation only. The exchange was managing risk, but in doing so, it manufactured a crash in the paper price, while the physical market told a completely different story. And that story is where this gets dangerous. Here's the number that should concern every person who owns a silver futures contract. Right now, there are over 400 million ounces of silver tied to March 2026 futures contracts on the COMEX. The COMEX has 88.2 million ounces of registered silver, the metal actually available to deliver against those contracts. That is a coverage ratio of roughly 22%. Under normal conditions, that's manageable. Historically, only 3 to 5% of futures traders take physical delivery. Most roll their contracts or take cash. But here's what changed in February. Delivery demand surged to a record 98% of eligible contracts. 98%. The trust in the paper pricing system has collapsed so completely that institutional players are no longer willing to accept cash settlement. They want the physical bars in their own vaults. On January 30th, the same day paper silver crashed from $121 all the way to $64. More than 3.3 million ounces were withdrawn from COMEX vaults. These players weren't selling. They were withdrawing. They don't trust the exchange to make good on delivery. They want the metal out before the March cycle begins. Because if delivery demand in March holds anywhere near that 98% rate, and the exchange only has 88 million ounces against 400 million in open interest, the COMEX runs out of deliverable silver. And then what? The exchange has emergency powers. They can declare force majeure and force contract holders to accept cash at the current paper price, even if physical silver in Shanghai is 40% higher. They can halt trading entirely. They can impose immediate position limit reductions. And every one of those outcomes would destroy the paper silver market's credibility. And everyone would confirm that the price on your screen is fiction. Here's the most extraordinary thing happening in the silver market right now, and almost nobody is covering it. In Shanghai, physical silver is trading at a 40% premium to the COMEX price. While you're watching $86 silver, physical silver in China is clearing at the equivalent of $120 to $130 per ounce. Why can't traders just ship silver from New York to Shanghai and pocket that spread? 3 reasons. First, on January 1st, 2026, China reclassified silver as a national strategic asset and implemented strict export controls. China controls roughly 70% of global refined silver output. That supply is now locked inside its borders. Second, Western silver bars are typically 0.999 fine. Shanghai requires 0.99999 purity. To bridge that gap, you need refiners. And refiners are the third problem. The global silver refining system is at maximum capacity. Wait times now exceed several months. You cannot close a 40% spread when the refining queue is measured in quarters. On top of that, Germany's natural gas storage has dropped to 41.8% of capacity, far below the historical winter average. Silver refining is energy intensive. Major European refiners, Agossi in Germany, Metalor in Switzerland, and Umicore in Belgium, are all at direct risk of curtailment if gas levels fall further. A gas-driven slowdown in European refining removes millions of ounces from a market already 5 years into a structural deficit. So when you see $86 silver on the COMEX, understand what you're looking at. It's an isolated derivative. It no longer reflects the cost of acquiring physical silver in the real world. The real price, as determined by actual physical demand in the world's largest industrial economy, is somewhere between $120 and $130. That gap cannot stay open forever. Either the paper price rises to meet physical reality, or the paper market loses its authority to set prices at all. Now let's talk about who is winning right now. On February 23rd, JPMorgan Securities was simultaneously issuing and stopping delivery notices across gold, silver, and copper. The net direction, they are buyers. They are taking delivery. Earlier in the month, when paper silver crashed near $78 on January 30th, JPMorgan stood for delivery on over 3 million ounces. 3 million ounces. At distressed prices, while retail traders were being wiped out by margin calls. The largest bullion bank in the world used the liquidity crisis to refill its physical vaults at a discount. The same margin hike that destroyed leveraged longs handed JPMorgan physical silver at prices that may prove to be generational. That's the silver trap in its clearest form. The short covering rally at $86 is not a buying signal for you. It is the price window during which institutions are closing paper shorts and taking physical delivery before the March crunch. And once that phase is complete, the mechanical bid from short covering disappears. The paper price could drop, but the physical price in Shanghai, in Dubai, in the hands of industrial buyers, will not follow it down. The gap widens until the paper system either reprices violently or cracks. Here's what the bearish case on silver is missing entirely. The real bid isn't coming from speculators. It's coming from sectors that cannot substitute away from silver and cannot wait for a lower price. Solar panel manufacturing consumed 160% more silver in 2025 than it did in 2019. Not because panels use more silver per unit. Engineers have worked hard to reduce that. But because the volume of new installations has overwhelmed those efficiency gains. AI data centers require silver for high-performance electrical connections. Defense procurement in 2026 is heavily weighted towards systems that require significant quantities of high-purity silver. These are not financial buyers who exit when sentiment turns. These are industrial buyers with committed production schedules. They pay what the physical market asks. And because they require 0.9999 fine silver, the same purity bottleneck that makes the Shanghai arbitrage unclosable, they are effectively outbidding every other participant in the market. The paper price can be pushed around by margin hikes and Fed expectations. The industrial bid cannot. That is the floor beneath the floor, and it is rising. Let me pull this together. The paper price at $86 is held up by one thing: shorts covering their positions. That is a mechanical finite bid. When the last short has closed, the support is gone. At that point, the paper price could fall further. Headlines will say silver is crashing. But here's what will be happening at the same time. Physical silver in Shanghai will still be $120 to $130. COMEX registered inventory will still be 88 million ounces against a 400 million ounce obligation. Institutional players will have finished their physical accumulation. And March delivery demand from industrial users and large-scale buyers will begin hitting the exchange. That is when the math event happens. That is when a paper price of $74 and a physical price of $130 put the system under stress it was not built to handle. The silver trap is the illusion that silver is weak because the paper price is weak. The metal is not going anywhere. It's moving out of the paper exchange system and into physical custody at the exact price window that the big players needed to make that happen. I'm not telling you what to do with this. This is analysis, not financial advice. But I'll say this much. Every time a commodity market has shown this kind of divergence between paper and physical, this kind of open interest collapse alongside a delivery crunch, the paper price eventually caught up to reality every time. If this changed how you're thinking about what's happening right now, hit like, subscribe, and tell me in the comments, are you watching the paper price or the physical market? Because right now, they are telling completely different stories. I'll see you in the next one.